Let us have understanding, friends, of the question. The question says that there are two companies, S and D. Both of them are planning to merge. The total values of the companies are dependent on fluctuating business conditions. The following information is given for the total value, that is debt and equity structure of each of the two companies. Everybody is requested to concentrate over here. First of all, let us understand for S Limited. For medium growth and for slow growth, everybody is requested to concentrate over here. Total value which is given to us is 550 lakhs and 410 lakhs. The total value is consisting of debt and equity both. You have been provided with the information that current debt of Dimple Limited is 65 lakhs and of Simple Limited it is 460 lakhs. So 460 is the value of debt included in this. So remaining is the value of equity. Now the total value is 410. So how can we pay 460 to debt holders? Whatever the value of the company, that is less than the debenture value. So what we have to do, the total value itself will be given to the debentures. And since equity share capital has limited liability, so in that case the value of equity is 0. Like that we understand. I repeat that once again. We understand that, say, if at all the total value of the firm is exceeding that value, then remaining is the value of equity. Total value of the firm exceeding that value, then remaining is the value of equity. However, if total value of the firm is less than that value, then in that case the company will go in liquidation. Whatever assets of the company that will be given to the debenture holders, 410, and equity value will go down to 0, like that we understand. That is the way we are required to understand over here. As far as the Dimple Limited is concerned, for that we understand like this: total value, debt value and equity value. You can see that the total value is given to us 825 lakhs and 590 lakhs. As far as the Dimple Limited is concerned, it has debt financing of 65 lakhs. So 825 minus 65, 760 is the value of equity. 590 minus 65. So we understand that 525 is the value of equity. So this is what we understand is the each of the growth situation has some probability. What is probability? 0.6 and 0.4. So we understand that says 60% chances of this debt value and this debt value, 40% chances of this debt value and this debt value, 60% chances of this equity value and this equity value, 40% chances of this equity value and this equity value. With that, expected value of debt and expected value of equity can be found. You read the question carefully. The question says that calculate expected value of debt and expected value of equity separately for the merged entity. So expected value of debt and expected value of equity is calculated independently for the merged entity. That is the way we are supposed to make the calculation of answer. Please write down a note. I am dictating a note to you. You are requested to write down note along with me. Total value of firm, comma, is divided into two parts, comma, debt and equity, full stop. From total value of firm, comma, value of debt is subtracted, comma, to calculate value of equity, full stop. However, if value of firm is less than value of debt, comma, then in that case entire value of firm is attributable to debenture holders, full stop. In that case value of equity is zero, full stop. Further write down, friends, equity shareholders have liability limited to face value of equity share, comma, if equity share capital is fully paid up, then for shortfall of payment to debenture holders cannot be claimed from equity shareholders, full stop. So in that case value of equity is taken as zero, full stop. So friends, working note number 1, calculation of value of debt. and value of equity of Simple Limited. Business condition: medium growth, slow growth. Total value, that is debt and equity, 550 and 410. Value of debt 460 and limited to 410 only. This is an important point for you to understand, friends, because of which we are doing this question in classroom. Value of equity is difference of these two. Value of equity is difference of these two, that is 0, because the value of firm is less than value of debt. Please take down answer from board. Let us see working note number 2. Calculation of value of debt and value of equity of Dimple Limited. Business condition: total value minus debt value, this is the value of equity. In both the cases, total value of the firm exceeding value of debt, so remaining is the value of equity. Please take down answer from board. Let us see working note number 3, calculation of expected value of debt of merged entity. Business condition, medium growth, slow growth. Value of debt of Simple Limited and Dimple Limited, we have calculated that 460 and 410 respectively, and 65 in each of the case. Total value, summation of this two. Probability for each of the growth condition is provided to us. Probability into x. With that mean x bar is calculated. So we understand that this is the value of debt, expected value of debt of merged entity. Like that we understand. Please take an answer from board. Let us see friends, next working note, calculation of expected value of equity of merged entity. Business condition is given, value has been found by us. Summation of this two is the total value, to that probability is assigned. Probability into x, with that expected value of equity is found. Please take an answer from board. Let us see calculation of expected value of firm, that is total value of debt and equity. Expected value of debt plus expected value of equity. Value of debt is 505 lakhs. Value of equity is 720 lakhs. Summation of that is 1225 lakhs. Please take the answer from board. Let us see question number 9C. Once again a question from Institute publication. B Limited is a highly successful company and wishes to expand by acquiring other firms. So B Limited is acquiring firm, that is A Limited, as per our understanding. Its expected high growth in earning and dividend is reflected in its price earning ratio of 17 times. So it has been provided that PE ratio, price earning ratio, is 17 times. The board of directors of B Limited has been advised, if it were to take over the firms with a lower price earning ratio than its own and a discharging consideration by issuing equity shares. Let us read that once again. The board of directors of B Limited has been advised that if it were to take over the firms with a lower price earning ratio than its own. So information is given that take over firms, comma, having lower price earning ratio. And discharging consideration by issue of equity shares, plus discharge consideration by issue of equity shares. Then it could increase its reported earning per share. So in that case, it will be able to increase its earning per share. C Limited has been suggested as a possible target for takeover. So there is a company called C Limited which is possible target for takeover. So C Limited is T Limited as per our understanding, that is target company, which has price earning ratio of 10 times, PE ratio 10 times, and 100 shares in issue with share price of rupees 15. So we have been provided with the market price of the share as 15. Then you have been provided with the number of shares as 100. So I read that once again. C Limited has been suggested as a possible target for a takeover, which has price earning ratio of 10 times. It has 100 shares in issue with a share price of 15. B Limited has 500 shares in issue. Number of shares 500. With a share price of rupees 12. You are required to calculate, highlight the portion, change in EPS, change in earning per share of B Limited if it acquires whole of C Limited for rupees 15 per share, that is at current market price of the share. Assume the price of B Limited shares remain constant. Like that information is given. We know that as far as the earning after taxation is concerned, earning after taxation divided by number of shares is EPS. EPS into price earning ratio is MPS. So we can say that earning per share is 12 divided by 17. Earning per share is 12 divided by 17, and over here by 10, that is 1 rupee 50 paise. Earning per share into number of shares is earning after taxation. Over here it is 150, and over here we are required to make calculation, that is 500 number of shares into EPS 12 rupees and 17 paise. What is the question? The question says that we are required to calculate change in EPS of B Limited resulting from acquisition. So whatever is this EPS, 12 divided by 17, that comes to 71 paise. The question says that, say, what is change in earning per share if B Limited acquires whole of C Limited at rupees 15 per share? That is the question. It means that, say, the consideration is discharged by issuing equity shares. Consideration is discharged by issuing equity shares. Over here we understand like this. We are required to make the calculation of exchange ratio as 15 divided by 12. Like that directly you can calculate 1.25, or otherwise you can make the calculation like this. 100 shares into 15 rupees. So 1500 rupees is the value of target company. Issuing one equity share of B for Bombay Limited, it means that consideration of rupees 12 is discharged. So 1500 divided by 12, that comes to 125 shares. 125 shares are issued against 100 number of shares of C Limited. So exchange ratio is 1.25. 125 shares are issued against 100 number of shares. So in that case exchange ratio is 1.25. Like that we understand. Or otherwise directly you can calculate 15 divided by 12, 1.25 into 100. So 125 shares are issued. Now coming to the important point. What is the question? The question is calculate what is change in EPS of B Limited. We know that, say, as far as the acquiring company is concerned, whatever is the EPS of the merged firm, that itself is earning per share attributable to acquiring company. EPS of the merged firm itself is EPS attributable to the shareholders of B Limited. Like that we understand. How to make calculation of EPS of the merged firm? We can say that earning after taxation of B Limited before merger plus earning after taxation of C Limited before merger divided by number of shares of B Limited before merger plus number of shares of C Limited into exchange ratio. Like that, so we can calculate the EPS of the merged firm. As far as the earning after taxation of B and earning after taxation of C is concerned, we'll make calculation of the same as EPS into number of shares. EPS into number of shares. That is the way earning after taxation is calculated. Number of shares of the merged firm is calculated as number of shares of B Limited 500 plus shares issued to C Limited 125. That is the number of shares of the merged firm. With that, we'll make the calculation of revise the earning per share. Like that we understand. Importantly friends, over here we have to understand, like the last paragraph, you are required to calculate change in EPS of B Limited if it acquires whole of C Limited for rupees 15 per share. In that case, we have to understand that, say, considering current market price of equity share, we are required to make the calculation of exchange ratio. Like that we understand. That is the way calculation is required to be made of exchange ratio, based on which we calculate the number of shares. I repeat my explanation once again. On reading of the question, we understand that basically we are required to make the calculation that what is change in earning per share attributable to acquiring company. What is change in per share as far as B Limited is concerned? It is EPS of the merged firm minus EPS of B Limited before merger. EPS of the merged firm minus EPS of B Limited before merger. That is what the calculation which is required to be made by us. As far as the EPS of B Limited before merger is concerned, it will be calculated taking into account market price per share information and price earning ratio information. Market price per share information and price earning ratio information. With that, EPS of B Limited, that is EPS of acquiring company before merger, is required to be calculated. That comes to 71 paise. That comes to 71 paise. As far as the EPS of the merged firm calculation is concerned, for that we require EAT information of B Limited, EAT information of C Limited, number of shares of the merged firm. We understand that, say, there is no information regarding synergy gain in form of increase in the earning. No information is provided regarding synergy gain in form of increase in earning. No information is provided in form of synergy gain in form of increase in earning. So we understand that, so there is no increase in earning due to merger. Simply earning after taxation of two independent firms is summed up, and that is what the earning after taxation of merged firm is. Simply two earning after taxation is required to be added to make the calculation of earning after taxation of merged firm. Like that we understand. For that, first of all, we are required to find earning after taxation, that is EPS into number of shares. With that, we will calculate the earning after taxes. That is 0.71 into 500 number of shares. This is EAT of B Limited, this is EAT of C Limited. Summation of both of them is earning after taxation of the merged firm, divided by the number of shares of the merged firm, that is NA, that is 500 plus NT into ER, 100 shares into exchange ratio 1.25, or you can calculate the answer like this. Whatever is the EPS of the merged firm, from that EPS of B Limited before merger 71 paise is subtracted, and with that we will calculate the change in EPS due to merger. Working note number 1. Calculation of number of shares to be issued by B Limited to shareholders of C Limited. Method number 1 of calculation. In that, first of all, we will make the calculation of exchange ratio. MPS of C before merger divided by MPS of B before merger. That is MPS of target company divided by MPS of acquiring company. So it is 1.25, or we can say that it is 1.25:1. In a way that we understand that it is 15 rupees per share divided by 12 rupees per share. With that, say, it can be calculated, and it is 1.25, or it is 1.25:1. So number of shares to be issued is NC into ER, that is 100 shares into 1.25, 125 shares. Please take down answer from board. Writing first working note once again. Calculation of number of shares to be issued by B Limited to shareholders of C Limited by method number 2. In that, first of all, market value of the target company is found by us. Number of shares of C Limited before merger 100. MPS of C Limited before merger is 15. 100 shares into 15 rupees per share. With that, so we can calculate the market value of the target company. Market value of C Limited before merger is 1500. MPS of B before merger is 12. Issuing one equity share, it is deemed that consideration of rupees 12 is satisfied. So for consideration of 1500, 125 number of shares are to be issued. Please take down answer from board. Let us see calculation of EPS of B Limited before merger and earning after taxation of the merged firm. We know that price earning ratio is MPS upon EPS. So EPS is MPS divided by price earning ratio. Earning after taxation is EPS into number of shares. So it is MPS upon price earning ratio into number of shares. With that, earning after taxation can be found. In order to calculate the EPS of the merged firm, we need to have earning after taxation of merged firm. Earning after taxation of the merged firm is earning after taxation of A Limited plus T Limited. So B Limited, C Limited and merged firm. Market price of the share 12 rupees and 15 rupees respectively. Price earning ratio 17 times and 10 times respectively. EPS, MPS upon price earning ratio 12 rupees per share divided by 17 times. 15 rupees per share divided by 10 times. So it comes to 0.7059. It comes to 1 rupee 50 paise. EPS into number of shares is earning after taxation 352 rupees and 95 paise and 150 rupees. Summation of this two is 502 rupees and 95 paise. Like that, we can calculate EPS of B Limited before merger, which is required later on for the purpose of comparison, and earning after taxation of the merged firm, with which we will calculate EPS of the merged firm post acquisition. Please take down answer from board. Working note number 3, calculation of EPS of the merged firm, that is EPS of B Limited post merger. It is earning after taxation of merged firm divided by number of shares of the merged firm, that is NB plus shares issued to C Limited. NB is 500 shares plus shares issued to C Limited 125. Earning after taxation of the merged firm is 502 rupees and 95 paise. So 502 rupees 95 paise divided by 625 shares, that comes to 80.47 paise. Please write an answer from board. Let us see the working note for calculating change in EPS of B Limited. EPS attributable to shareholders of B Limited in merged firm is EPS of the merged firm itself, that is 80.47 paise, less EPS of B Limited before merger is 70.59 paise. So we can see that there is increase of 9.88 paise. Please take the answer from board. Question number 10A. AB Limited has recently approached the shareholders of CD Limited. AB Limited has recently approached shareholders of CD Limited, which is engaged in, highlight the portion, same line of business as that of AB Limited, with a bid of 4 new shares in AB Limited for 5 shares of CD Limited, or cash alternative of rupees 360 per share. So shareholders of AB Limited have approached the shareholders of CD Limited asking that we will give you 4 shares for every 5 shares held by you, or otherwise we will give you rupees 360 per share. Like that information is given. Past records of the earning of CD Limited had been poor, and the company's shares have been out of favor with the stock market for some time. Pre-bid information for the year ended 31st of March 3001 are as under: for AB Limited and for CD Limited. Equity share capital, number of shares, pre-tax profit, price earning ratio, estimated post-tax cost of equity per annum. Both AB Limited and CD Limited pay income tax at the rate of 30%. Current earning growth forecast is 4% for the foreseeable future for both the companies. So growth rate is likely to be 4% for AB Limited and 4% for CD Limited as well. You are required to answer that. 1, 2, 3, 3 questions have been given. Let us focus only on the first question right now. Assuming, highlight the portion, no synergy exists. Assuming no synergy exists, you are required to evaluate whether proposed share-to-share offer is likely to be beneficial to shareholders of CD Limited using merger terms available? Question mark. So in the first part of the question, we are required to answer, if at all no synergy is likely to take place. Assuming no synergy, then from CD Limited point of view, whether it should accept the offer for shares or it should accept the offer for cash. That is the question. Everybody is requested to go through the question, please. Friends, in order to evaluate from CD Limited point of view that whether it should go for cash offer or it should go for shares offer. We are required to make comparison between both the values. As far as the cash offer is concerned, it is 360 rupees, and as far as the shares offer is concerned, it is MPS of the merged firm multiplying with exchange ratio. Whatever is MPS of the merged firm into exchange ratio, that is 0.8. That is what we understand is the value attributable to shareholders of CD Limited in the merged firm. Like that we understand. Everybody is requested to stop writing. Let me explain you. Now, as far as the calculation of market price of the share of the merged firm is concerned, we are required to apply the formula market value of the merged firm divided by number of shares of the merged firm. So we understand that it is market value of the merged firm divided by N of AB Limited plus N of CD Limited into exchange ratio 4 divided by 5, that comes to 0.8. So market value of the merged firm divided by number of shares of AB Limited, that is 2.4 lakh plus number of shares of CD Limited 1.7 lakh into exchange ratio 0.8. So as far as the calculation of the MPS of the merged firm is concerned, this is the formula which we are required to apply. Market value of the merged firm divided by number of shares of the merged firm, that is N of AB Limited plus N of CD Limited into exchange ratio. Now, as far as the calculation of the market value of the merged firm is concerned, in that we have two methods. Let us discuss method number 1. As far as the calculation of the market value of the merged firm is concerned, there are two methods. Let us discuss method number 1. Method number 1 is very simple, like AB Limited, CD Limited and merged firm. Earning after taxes. You can see that, say, AB Limited earning before taxation is given to us 125 lakhs. So 125 lakhs into 1 minus 0.3. For CD Limited, it is 110 lakhs into 1 minus 0.3. That is the way earning after taxation of AB Limited, earning after taxation of CD Limited can be found. As far as the price earning ratio is concerned, it is provided to us as 11 times, it is provided to us as 7 times. Earning after taxation into price earning ratio is market value of AB Limited, product of this two is the market value of CD Limited. Summation of this two is the market value of the merged firm. Simple. It is earning after taxation into price earning ratio is the market value of AB Limited. Earning after taxation into price earning ratio is the market value of CD Limited. Since there are no synergy gain, so summation of the two independent market value is the market value of the merged firm. Like that, so this is the first method by which you can make the calculation of answer. The second method is like this. In method number 2, working note number 1, calculation of weighted average price earning ratio. AB Limited, CD Limited. Earning after taxes, that is earning before taxation 25 lakhs into 0.7, 110 lakhs into 0.7. This is earning after taxes of AB Limited and CD Limited independently. Whatever the values that we have, for that we calculate the proportion. Summation of the proportion is 1. Proportion will be multiplied with the price earning ratio. Price earning ratio of AB Limited before merger is 11 times, and for CD Limited it is 7 times. So proportion into price earning ratio, proportion into price earning ratio. Like that, we'll make the calculation of weighted average price earning ratio of the merged firm. Like that, we'll make the calculation of weighted average price earning ratio of the merged firm. That is our first working note. Then working note number 2, calculation of market value of the merged firm. It is earning after taxation of the merged firm into weighted average price earning ratio. That is earning after taxation of AB Limited plus earning after taxation of CD Limited. Summation of these two is earning after taxation of the merged firm. Earning after taxation of AB Limited plus earning after taxation of CD Limited. Summation of those two is earning after taxation of the merged firm multiplying with weighted average price earning ratio, and with that market value of the merged firm can be found. Once we compute market value of the merged firm, the same will be divided with number of shares of the merged firm in order to make the calculation of MPS of the merged firm. MPS of the merged firm into exchange ratio is MPS attributable to shareholders of target company, that is shareholders of CD Limited. Whatever is the MPS attributable to shareholders of CD Limited will be compared with 360 rupees. We can say that, say, from shareholders of CD Limited, higher of these two is, say, the value that CD Limited shareholders will be ready to accept. Like that, we are required to answer the first part of the question. So, answer for the first question in that working note number 1, calculation of market value of the merged firm. Method number 1 for making this calculation. Name of the company AB Limited and CD Limited. Earning before taxation is given. Earning before taxation into 1 minus T is earning after taxation. Earning after taxation into price earning ratio. With that, we'll make the calculation of the market value of the firm. EAT into price earning ratio. EAT into price earning ratio. This is the independent value. Summation of both of them is market value of the firm. That is market value of the merged firm. That is 962.5 lakhs plus 539 lakhs. That is 1501.5 lakhs. Please take down answer from board. Friends, first part of the question, in that working note number 1, once again I am doing with the method number 2. Calculation of market value of the merged firm by adopting method number 2. If at all there is no synergy gain, if at all there is no synergy gain, if at all there is no synergy gain, then there are two methods by which we can calculate MVM. First method that we already have done, and this is the second method. In that, first of all, we are required to make the calculation of weighted average price earning ratio of the merged firm. Name of the company AB Limited and CD Limited. Earning before taxation is 125 lakhs, 110 lakhs. Earning after taxation is 70% of this, 70% of this. Summation of that is 164.5 lakhs. Proportion / weight 87.5 lakhs divided by 164.5 lakhs. 77 lakhs divided by 164.5 lakhs. Proportion weight, summation of that is always 1. So in proportion of earning after taxation, we'll make the calculation. Proportion into price earning ratio. Like that, we make the calculation of weighted average price earning ratio, which is price earning ratio of the merged firm. Once we calculate weighted average price earning ratio, it will be multiplied with earning after taxation of the merged firm, that is market value of the merged firm. Earning after taxation of the merged firm is earning after taxation of AB Limited plus earning after taxation of CD Limited, summation of both of them multiplied with weighted average price earning ratio of the merged firm, that is 87.5 lakhs plus 77 lakhs. Summation of that multiplying with 9.1276 times, and it comes to 1501.5 lakhs. Please take down answer from board. In examination, either of the two methods, in examination, either of the two methods, in examination, either of the two methods is required to be applied for calculation of market value of the merged firm. Friends, you may refer answer of question number 2A. You may refer answer of question number 2A for this answer which we have calculated as market value of the merged firm. In that question we have done working in detail. Along with that I have dictated note also to you. Working note number 2, calculation of MPS of the merged firm. That is market value of the merged firm divided by number of shares of the merged firm. Market value of the merged firm has already been found by us, 1501.5 lakhs. Number of shares of the merged firm is NAB plus NCD into exchange ratio. NAB is 2.4 lakh. NCD is 1.7 lakhs into 4 divided by 5, because 4 shares are given for every 5 shares held by shareholders of CD Limited. 4 divided by 5 is 0.8. So 0.8 into 1.7 lakh plus 2.4 lakh. Numerator is 1501.5 lakhs. Number of shares of the merged firm is 2.4 lakh plus 1.36 lakh, that is 3.76 lakhs. Market value of the merged firm divided by number of shares of the merged firm, that is MPS of the merged firm, 399 rupees and 34 paise. Please take down answer from board. Let us see the decision making from shareholders of CD Limited. Decision making from shareholders of target company. If it is accepting cash offer, if it is accepting shares offer, then what amount it will get? In case of shares offer, market price attributable to shareholders of target company is MPS of the merged firm into exchange ratio. 399.34 into 0.80, so 319.47 rupees per share. Against that, in cash offer, it will receive rupees 360. So we understand that, say, if at all there is no synergy, then in that case, shareholders of CD Limited would be interested in cash offer. shareholders of CD Limited will be interested in cash offer? Please take down answer from board. Let us see second part of the question. AB Limited's director might expect their own pre-bid price earning ratio to be applied to combined earning. Whether merger terms are favorable for CD Limited? Question mark. So the question is providing information that price earning ratio of merged firm equals to 11 times. Price earning ratio of the merged firm equals to 11 times. That is, price earning ratio of AB Limited itself is the price earning ratio of the merged firm. In this situation, as far as the market value of the merged firm calculation is concerned, it will be earning after taxation of the merged firm into price earning ratio of the merged firm. This is the only formula that we have to calculate MVM, market value of the merged firm. We already have calculated earning after taxation of merged firm 164.5 lakhs into 11 times. That is the way market value of the merged firm will be calculated. Once we calculate market value of the merged firm, based on that we will calculate MPS of the merged firm. What is MPS of the merged firm? It is market value of the merged firm divided by number of shares of the merged firm. Market value of the merged firm has been calculated by us in the first step. Then number of shares of AB Limited plus number of shares of CD Limited into exchange ratio. Based on that, MPS of the merged firm will be calculated. Whatever is the MPS of the merged firm, into exchange ratio, that is 0.8, into exchange ratio, that is 0.8, is MPS attributable to shareholders of CD Limited? Is MPS attributable to shareholders of CD Limited? That market value attributable to shareholders of CD Limited will be compared with 360 rupees. And between these two, once again, higher value will be selected by shareholders of CD Limited. Like that we understand. I repeat that once again. What we are required to do? We are required to first of all calculate market value of the merged firm. For calculation of the market value of the merged firm, we will apply the formula EAT of the merged firm into price earning ratio of the merged firm. The question provides information that price earning ratio of the merged firm is 11 times, that is price earning ratio of AB Limited before merger itself is price earning ratio of the merged firm. Based on that, MVM, market value of the merged firm, will be found. The same will be divided by The same will be divided by number of shares of the merged firm. Number of shares of the merged firm is NAB plus NCD into exchange ratio. That is the way MPS of the merged firm will be found. Whatever is the MPS of the merged firm into exchange ratio is MPS attributable to shareholders of CD Limited. That MPS attributable to shareholders of CD Limited will be compared with 360 rupees. Higher of these two is the value which is selected by shareholders of CD Limited, like that we understand. Answer for the second question. In that working note number 1, calculation of market value of the merged firm. It is earning after taxation of the merged firm multiplying with price earning ratio of the merged firm. That is EAT of AB Limited before merger plus EAT of CD Limited before merger. Summation of this two is EAT of the merged firm into price earning ratio of the merged firm. EAT of AB Limited before merger is 87.5 lakhs. EAT of CD Limited before merger is 77 lakhs into price earning ratio of the merged firm is 11 times. So 164.5 lakhs into 11 times, that is 1809.5 lakhs. Please take down answer from both. Working note number 2, calculation of MPS of the merged firm. That is market value of the merged firm divided by number of shares of the merged firm. That is 1809.5 lakhs divided by NAB plus NCD into exchange ratio. Number of shares of AB Limited before merger 2.4 lakhs. Number of shares of CD Limited before merger 1.7 lakhs into 4 divided by 5. 4 shares are offered for every 5 shares. 4 divided by 5, that comes to 0.8. So market value of the merged firm divided by NAB Limited plus NCD Limited into exchange ratio. 1.7 lakh into 0.8, that comes to 1.36 lakhs, which is added to 2.4 lakh, so it comes to 3.76 lakhs. Market value of the merged firm divided by number of shares of the merged firm. With that, MPS of the merged firm can be found. MPS of the merged firm into exchange ratio is MPS attributable to shareholders of target company, that is shareholders of CD Limited. We understand that, say, from CD Limited point of view, market value attributable to them post merger will be compared with 360, and higher of these two will be selected by them. Please take down answer from both. Let us see the decision making from shareholders of target company, shareholders of CD Limited point of view. Shares offer and cash offer. As far as the shares offer is concerned, we understand that MPS of the merged firm into exchange ratio is MPS attributable to shareholders of CD Limited. 481.25 into 0.8, that is 385, which is compared with 360, and once again higher of these two, that is shares offer, is selected. Please take down answer from board. Friends, you can refer answer of question number 2C for computation of the market value of the merged firm that we have done in the second part of the question. In that we have done working in detail question number 2C, in that market value of the merged firm calculation that we have done in detail. You may refer that if you want. Let us see third part of the question. Also comment on value of the two companies, that is AB Limited and CD Limited, from the constant growth form of dividend valuation model, assuming, highlight the portion, all earnings are paid as dividend. Let us read the question once again. Also comment on value of the two companies from the constant growth form of dividend valuation model, assuming all earnings are paid out as dividend. Everybody is requested to stop writing. Let me explain. I hope you remember that in one of the question earlier, we had done valuation of the firm based on earning capitalization method. Based on earning capitalization method. The same working is required to be done over here. Discounted value of the earning is required to be found by us. Discounted value of the earning is required to be calculated by us. How we can make that calculation? That calculation is required to be made like this. Earning after taxation of AB Limited is 87.5 lakhs. CD Limited, it is an amount of rupees 77 lakhs. Number of equity shares 2.4 lakh and 1.7 lakh. Earning after taxation divided by number of shares will give answer of EPS. This is understood to be EPS of year 0. This is understood to be EPS of year 0, that is current EPS. So we can say that P0 is equal to EPS at the end of year 1 divided by KE minus G. We are required to make the calculation of price of the security based on discounted value of the earning. based on discounted value of the earning. So whatever EPS that the company is going to generate from end of year 1 onwards for perpetuity is discounted to year 0. Like that we understand. Let us say that this EPS is X and this EPS is Y. So for AB Limited we can say that X into 1.04 divided by cost of equity 12% less growth rate 4%. On the other hand, Y into 1.04 divided by KE minus E, cost of equity 10%, less growth rate 4%. So the latest year earning per share into 1 plus G. So this is EPS at the end of year 1 divided by KE minus G. So this is the discounted value of earning. This is the discounted value of earning. So like that, say first of all we are required to make the calculation of discounted value of the earning, and based on that price of the security is required to be found. Friends, I am dictating a note to you. You are requested to write down answer along with me. First point, in third part of the question, as per institute suggested answer, we are required to calculate value of equity share based on earning capitalization method. Full stop. Second point, discounted value of earning is required to be calculated comma, that is from end of year 1 onwards, for infinity. Whatever earning that company is going to earn is discounted in present value term. Full stop. Third point, for the purpose of this calculation, comma, we have to apply following formula. Full stop. P0 is equal to E1 divided by Ke minus G. E1 is calculated as E0 into 1 plus G divided by Ke minus G. We understand that say E0 stands for EPS of current year and E1 stands for EPS at the end of year 1. At the end of year 1. Full stop. Let us see calculation of P0 based on earning capitalization method. Name of two companies AB Limited and CD Limited. Earning after taxes is 87.5 lakhs and 77 lakhs. EPS is earning after taxation divided by number of shares. 87.5 lakhs divided by 2.4 lakhs. 77 lakhs divided by 1.7 lakhs. So this is EPS. This is EPS of year 0. So EPS of year 1 will be calculated as EPS of year 0 into 1 plus G. So EPS at the end of year 1 is 36.46 into 1.04, 45.29 into 1.04. So this is EPS at the end of year 1. P0 is equal to E1 divided by Ke minus G. So 474 and 785 respectively. Please take down answer from board. Reading third part of the question once again. Also comment on the value of the two companies from the constant growth form of dividend valuation model, assuming all earnings are paid as dividend. So let us have comparison of actual market price of the security with P0 based on earning capitalization method. AB Limited, CD Limited. Earning after taxes already calculated by us. Price earning ratio given to us. So multiplication of this two is the market value, that is 962.5 lakhs and 539 lakhs, divided by the number of shares will give market price of the share 401 rupee and 317 rupees. 401 rupee and 317 rupees. So this is the market price of each of the company before merger. Based on earning capitalization method, price is 474 and 785 rupees. 474 and 785 rupees. So actual price is lower than like the market price based on earning capitalization method. Actual price is less than market price of the security based on earning capitalization method. Like that we can see. So we can say that the market price of the each of the company's equity share is undervalued. However, market price of the CD Limited is substantially undervalued. Market price of the CD Limited equity share is substantially undervalued. That is what you can see. Why? For that the reasoning is provided to you in the very first paragraph, third line. Past records of the earning of CD Limited had been poor and company's shares have been out of favor with stock market for some time. In the recent past, CD Limited's earning had been poor. So market price of the equity share is also less. Actual equilibrium price is substantially high. So over here what we are required to answer? We are required to answer like this. From AB Limited point of view, there is an excellent opportunity to acquire CD Limited. From AB Limited point of view, there is an excellent opportunity to acquire CD Limited, because on acquisition of CD Limited, it is required to pay premium, so which is calculated based on the current market price of equity share of CD Limited. Shareholders of CD Limited will be happy if at all they get a price which is more than 317. They are happy if at all they get a value which is more than 317. However, AB Limited is acquiring a company which is having equilibrium value of 785 rupees. AB Limited is able to acquire a firm which is having substantially higher value. So we can say that, say, from shareholders of AB Limited point of view, that is really a good opportunity to acquire CD Limited. Like that we are required to pass comment. Please write down a note. I am dictating a note to you. Actual price of the security, comma, for AB Limited and CD Limited is lesser than P0 based on earning capitalization method. Full stop. With paragraph write down. Price of CD Limited is substantially less, comma, in comparison with P0 based on earning capitalization method. P0 based on earning capitalization method. Full stop. It is because of the reason that past records of the earning of CD Limited had been poor. Full stop. So stock of the company comma, is out of favor. Full stop. So MPS is substantially less in comparison with its equilibrium price. Full stop. With paragraph write down. From shareholders of AB Limited. Comma, there is a good opportunity to take over CD Limited. Shareholders of CD Limited must be expecting premium on current market price comma, which is only rupees 317. So by offering a premium over current market price, comma, AB Limited can acquire comma, a company which has present value of rupees 785 per share, full stop. Let us see question number 10b. PQR Limited is a management consultancy firm in the industry for last 10 years. It got listed its equity shares 4 years ago at a recognized stock exchange. The company has pursued a policy of aggressive growth and specializes in providing services to the entities in high technology and high growth sectors. The company has no leverage element in their capital structure and financed by equity shares of rupees 50 crore of rupee 2 per share par value. So there is a company called PQR. Number of equity shares, face value per share, and equity share capital. It has been provided that the equity share capital is rupees 50 crore, face value is 2 rupees per share, and number of shares are 25 crore. The company's result for the year ending 31st of March 2001 have just announced. Profit before taxation were 12.66 crore. As per Chairman cum Managing Director's statement included in the forecast column of company's annual report for the year ending 31st of March 2001, earning might be expected to rise by 4%, which is lower than the annual rate in the recent years. This is due to global recession, especially in US economy. So the growth rate is 4%. XYZ Limited is another company. XYZ Limited is another company in the same business, but has been established much longer. It resources more to traditional business sectors and its earning track record has been erratic. In most of the daily newspaper, poor management have been blamed for poor performance of the company, and due to this, stock of the company in the market had lost its value for some times. The current earning forecast of XYZ Limited is also 4% for foreseeable future. So growth rate is 4% for foreseeable future. The capital structure of the company consisting of rupees 18 crore equity share capital of rupee 1 par value. So face value is 1 rupee per share. Number of equity shares have been provided as 18 crore and equity share capital is rupees 18 crore. The profit before taxation of the company for the year ending 31st of March 3001 is 11.25 crore. PQR Limited has recently approached shareholders of XYZ Limited. So PQR is acquiring company and XYZ is target company, with a bid of 5 new shares in PQR for every 6 shares in XYZ. Otherwise, shareholders can accept a cash payment of 3 rupee 45 paise per share. So, consideration is offered in form of shares, in form of cash. In case of shares, offer 5 for every 6 shares held, and in case of cash, offer 3 rupee 45 paise per share. 3 rupee 45 paise per share, like that information is given. Following the announcement of this bid, market price of PQR shares fell by 10%, whereas market price of XYZ rose up by 14%. The price earning ratio and dividend yield of these two companies and other two companies in the same industry immediately prior to the bid announcement is as under. So price earning ratio, dividend yield, highest, lowest, market price, and so on information is given for PQR, XYZ, LMN and DEF Limited. The corporate tax rate is 30%. Tax rate is 30%. PQR Limited is post-tax cost of equity is 13%. So cost of equity for PQR Limited is 13%. And for XYZ Limited, it is 11%. For XYZ Limited, it is 11%. Evaluate whether proposed share for share offer likely to be beneficial to shareholders in both PQR and XYZ. Please use the information and the merger terms available above. Further, you may make appropriate assumption to forecast post-merger values. Everybody is requested to go through the entire question, please. Very simple question. Please go through the entire question, friends. Reading second last paragraph, evaluate whether the proposed share for share offer likely to be beneficial to shareholders in both PQR Limited and XYZ Limited. Everybody is requested to stop writing. Let me explain you. We can understand something like this: PQR Limited and XYZ Limited. Everybody is requested to stop writing. Let me explain you. And merged firm. You can see that in the second paragraph, you have been provided with the information that earning before taxation of PQR Limited is 12.66 crore. Earning before taxation of XYZ Limited before merger is 11.25 crore. Tax rate is provided to us after the table 30%. So earning after taxation is earning before taxation into 1 minus 0.3. So 12.66 crore into 0.7. 11.25 crore into 0.7. That is the way earning after taxation can be calculated for PQR and for XYZ. You have been provided with the price earning ratio information. For PQR Limited it is 11 times, for XYZ Limited it is 7 times. Earning after taxes into price earning ratio. That is the way market value can be found. Earning after taxes into price earning ratio. That is the way market value can be found. So market value of PQR plus market value of XYZ, summation of this two is the market value of the merged firm if there is no synergy gain. If there is no synergy gain. Number of shares of the merged firm. We can say that as far as the PQR Limited is concerned, the number of shares before merger is 25 crore, that is 50 crore divided by 2 rupees per share. This is 18 crore because over here face value is rupee 1 itself. So for the merged firm is 25 crore plus 18 crore into 5 divided by 6. In a way that the 15 crore shares have been issued. So the number of shares of the merged firm is 40 crore. So market value of the merged firm divided by the number of shares of the merged firm. With that we will calculate MPS of the merged firm. Whatever is the MPS of the merged firm itself is MPS attributable to shareholders of PQR Limited. And MPS of the merged firm into exchange ratio is MPS attributable to shareholders of XYZ Limited. Post-merger market value will be compared with pre-merger market value. We can say that the market value divided by number of shares is MPS. Market value divided by number of shares is MPS. So post-merger MPS will be compared with pre-merger MPS to calculate profit/loss to shareholders of each firm. Then as far as the XYZ Limited is concerned, for that say it has been provided that 3 rupee 45 paise is the cash offer which is made. That sort of information is provided to us in the fourth paragraph. PQR Limited has recently approached the shareholders of XYZ Limited with a bid of 5 new equity shares in PQR for every 6 shares in XYZ. Otherwise, shareholders can accept a cash payment of 3 rupee 45 paise per share. So considering this information also, we are required to evaluate that which is more beneficial for XYZ Limited. This is the working that we are doing. This is the working that we are doing in a situation where there is no synergy gain. In a situation where there is no synergy gain. In that situation we are doing this working. In that case, market value of the merged firm can be calculated either by this method, that is what I have that is done on the board, and there is an alternative method also, that is earning after taxation of the merged firm into weighted average price earning ratio, into weighted average price earning ratio. With that, market value of the merged firm will be calculated. Let us see working note number 1. Calculation of MPS of PQR Limited and XYZ Limited before merger. PQR XYZ earning before taxes 12.66 crore, 11.25 crore. Tax rate is 30%. So EBT into 1 minus T. 12.66 crore into 1 minus 0.3, 11.25 crore into 1 minus 0.3. So this is earning after taxes. 8.862 crore and 7.875 crore. Earning after taxes into price earning ratio 11 times and 7 times is the market value of each of the company. 97.482 crore, 55.125 crore. Number of shares. For PQR Limited, 50 crore is the equity share capital, 2 rupees is the face value. So it is 25 crore number of shares, and 18 crore is the equity share capital divided by 1 rupee per share. That is 18 crore is the number of shares. Market value divided by number of shares will give MPS 3 rupee 90 paise and 3 rupee 6 paise. Please take down answer from board. Working note number 2, calculation of market value of the merged firm. Method number 1 of this calculation. Market value of PQR Limited before merger plus market value of XYZ Limited before merger. It is 97.482 crore plus 55.125 crore. So it comes to 152.607 crore. Please take down answer from board. Let us see, friends, method number 2. Let me explain you. Everybody is requested to concentrate over here. Method number 2 for calculation of market value of the merged firm. In that we will have the working like this. PQR Limited and XYZ Limited. Earning before taxes. We can see that earning before taxes is 12.66 crore for PQR and 11.25 crore for XYZ. Taking tax rate into account, will calculate earning after taxes, 70% of this and 70% of this. Summation of this two in this proportion / weight. We will make the calculation of weighted average price earning ratio of the merged firm. That is price earning ratio of PQR Limited before merger is 11 times and for XYZ Limited before merger it is 7 times. So proportion into price earning ratio. Proportion into price earning ratio. Summation of that is weighted average price earning ratio of the merged firm. Then earning after taxation of A plus earning after taxation of T into weighted average price earning ratio, with that market value of the merged firm will be calculated. With that market value of the merged firm will be calculated. That is the way we are required to make the calculation of answer. That is market value of the merged firm if at all there is no synergy gain. Working note number 2 once again, calculation of the market value of the merged firm by method number 2. In that, first of all, we are required to make the calculation of weighted average price earning ratio of the merged firm. Name of the company PQR XYZ. Earning after taxes 8.862 crore, 7.875 crore, which we have calculated in our first working note. Summation of that is 16.737 crore. 8.862 divided by 16.737. So the proportion of PQR's earning in the merged firm is 52.95% and for XYZ 47.05%. Proportion into price earning ratio. Proportion into price earning ratio. With that, weighted average price earning ratio is found, that is 9.118 times. Please take an answer from board. Friends, market value of the merged firm is earning after taxation of merged firm into weighted average price earning ratio of the merged firm. It is 16.737 crore, that is EAT of A plus EAT of T, into weighted average price earning ratio of the merged firm. With that, market value of the merged firm can be found. Please take an answer from board. Working note number 3, calculation of MPS of the merged firm, that is market value of the merged firm divided by number of shares of the merged firm. Market value of the merged firm is 152.607 crore, which we have calculated by two methods. In examination, one of them only is required to be shown, whatever may be comfortable to you. Number of shares of merged firm is number of shares of PQR Limited before merger plus number of shares of XYZ Limited before merger into exchange ratio. Number of shares of PQR Limited before merger is 25 crore. For XYZ Limited before merger it is 18 crore. Exchange ratio is 5 divided by 6. So 15 crore shares are issued, which is added to 25 crore. So the total number of shares become 40 crore. So in that case, MPS is 3 rupee 82 paise per share. Please take down this answer. Let us see the decision making from shareholders of XYZ Limited point of view. It has two offers. One is shares offer and another is cash offer. Consideration received. In case of shares offer, MPS of the merged firm into exchange ratio. MPS of the merged firm is 3 rupee 82 paise. Exchange ratio is 5 divided by 6. So MPS attributable to shareholders of XYZ Limited is 3 rupee 18 paise. Before merger it was 3 rupee 6 paise. So there is appreciation, there is increase of 12 paise. In case of cash offer, getting 3 rupee 45 paise against MPS of 3 rupee 6 paise. So we understand that if at all there are no synergic gain, from shareholders of target company, cash offer is preferable. Simple. Like that we understand. Please take down answer from board. Read on a note. I am dictating a note to you. From shareholders of XYZ Limited point of view, comma, if there are no synergy gain, comma, then in that case cash offer is better than shares offer. Full stop. In both options, comma, wealth of shareholders increase. However, it increases by higher value in case of cash offer. Full stop. With paragraph write down, if consideration is in form of shares, then MPS attributable to shareholders of target company is MPS of merge firm into exchange ratio. Full stop. Friends, MPS of the merge firm is 3 rupee 82 paise. If consideration is offered in form of shares and exchange ratio is 5 divided by 6, then MPS of the merge firm is 3 rupee 82 paise. MPS of PQR Limited before merger was 3 rupee 90 paise. It means that shareholders of acquiring company have loss if at all consideration is offered in form of shares, because MPS attributable to them reduces post merger. In a way that say an amount of wealth is shifted from PQR Limited to XYZ Limited in this case. We understand that say information is like no synergy gain. If at all there is no synergy gain, then in that case there is no gain / benefit due to merger. So in that case, one of the three situations can exist. First, break-even situation. Second, shareholders of acquiring company have profit and shareholders of target company have loss. And third, shareholders of acquiring company have loss and shareholders of target company has profit. So as far as this question is concerned, we have been provided with the third situation, in which we understand that say the shareholders of target company have profit and shareholders of acquiring company have loss. That is what we understand. In case of cash offer, there is more advantage to target company, so more loss to acquiring company. In case of shares offer, we can see that the advantage to target company increases. It means that loss to acquiring company also increases. So we can say that if at all there are no synergic gain, then neither cash offer nor shares offer is advantageous to the acquiring company, that is to PQR Limited. Please write down a note. I am dictating a note to you. From shareholders of PQR Limited, comma, we can conclude that comma, either in shares offer or in cash offer, comma, merger is not attractive to A Limited, that is PQR Limited. Full stop. With paragraph write down, in case of shares offer, comma, we can see that MPS of merged firm is less than MPS of PQR Limited before merger. Full stop. As there are no synergic gain, so whatever advantage that XYZ Limited is able to get, comma, it is transfer of wealth from PQR Limited. Full stop. Further write down with paragraph. We know that if there are no synergic gain, then one of the three situations is possible. Full stop. First, break even, comma, second, shareholders of PQR Limited will have profit, and shareholders of XYZ Limited will have loss. And third situation is reverse of second. Full stop. Over here, third situation is given. Comma, so shareholders of PQR Limited is not interested in merger. Full stop. Friends, reading second last paragraph of the question. Evaluate whether the proposed share for share offer likely to be beneficial to shareholders in both PQR and XYZ Limited. Please use the information and the merger terms available above. Then you have been given. You may make appropriate assumption to forecast post-merger value. Now, as far as this line is concerned, because of that, Institute has given further answer. Because of this line, Institute has given further answer. The further answer is given like this. That if at all price earning ratio of the merged firm is same as price earning ratio of the acquiring company before merger, then in that case, what is post merger value? And based on that an analysis is made. I repeat that once again. You can see that the last line of the question says that you may make appropriate assumption to forecast post merger values. Because of this line, Institute has given an extended answer in which Institute has made calculation of the market value of the merged firm, assuming that price earning ratio of acquiring company is remaining same as it was before merger. So in that case, Institute has made answer like this. Market value of the merged firm is earning after taxation of merged firm into price earning ratio of the merged firm. Earning after taxation of the merged firm is earning after taxation of PQR Limited before merger plus earning after taxation of XYZ Limited before merger into price earning ratio of the merged firm is 11 times. With that, market value of the merged firm is found, then MPS of the merged firm is found, MPS attributable to the shareholders of target company is found, which is compared with 3 rupee 45 paise, and like that say further evaluation is done. In a way that say almost the entire question is done once again based on this assumption. So accordingly we will also do the working in the classroom. In a way that say assuming that price earning ratio of the merged firm is same as acquiring company before merger, we will recompute the answer. Please write down a note. I am dictating a note to you. Assuming that price earning ratio of the merged firm comma is same as of A Limited, in bracket write down PQR Limited, bracket over, before merger, comma, market value of the merged firm, and price attributable to shareholders of each firm is calculated as under. Full stop. Let us see calculation of market value of the merged firm. It is earning after taxation of merged firm into price earning ratio of the merged firm. That is EAT of PQR Limited before merger plus EAT of XYZ Limited before merger into price earning ratio of the merged firm is 11 times, that is price earning ratio of PQR Limited before merger. 8.862 crore plus 7.875 crore into 11 times. So 16.737 crore into 11 times 184.107 crore. Please take down answer from board. Let us see calculation of MPS of the merged firm in this case. That is market value of the merged firm divided by number of shares of the merged firm. That is 184.107 crore divided by number of shares of PQR Limited plus number of shares of XYZ Limited into exchange ratio. Number of shares of XYZ Limited is 18 crore and exchange ratio is 5 divided by 6. So 15 crore number of shares have been issued to target company. So MPS of the merged firm is 4 rupees 60 paise. Please take down answer from board. Let us see the decision making from shareholders of XYZ Limited. There are two offers: cash, shares. Consideration received. Over here 3 rupees 45 paise. Over here MPS of the merge firm into exchange ratio. Less MPS before merger. 3 rupees 6 paise. Profit loss. Profit in the first case as well as second case. In either of the case there is profit. However, higher profit in case of shares offer. So the shares offer is selected. Please take down answer from board. If at all price earning ratio of the merged firm is same that of acquiring company before merger, then in that case MPS of the merged firm is 4 rupees 60 paise. MPS of A Limited, that is MPS of PQR before merger, is 3 rupee 90 paise. So what we can see? We can say that the market price per share increases from 3 rupee 90 paise to 4 rupee 60 paise. It increases by 70 paise. So we can say that as far as the shares offer is concerned, shares offer is going to give advantage to shareholders of acquiring company because MPS attributable to acquiring company increases. From shareholders of target company point of view, we can see that they also have selected shares offer instead of cash offer. It means that from acquiring company point of view, cash offer would be preferable, cash offer would be better than shares offer, because for target company, whatever is higher profitable is higher costly for acquiring company. From target company point of view, whatever option that is more profitable is more costlier for acquiring company, like that we understand. So over here, this is the way we are required to answer the question. Please write down a note. I am dictating a note to you. You are requested to write down answer along with me. If price earning ratio of the merged firm is same as PE ratio of PQR Limited before merger, so in that case shareholders of acquiring company finds merger attractive, because MPS of merged firm is higher than MPS of PQR Limited before merger. Full stop. MPS attributable to them increases by 0.70. In bracket write down 4.6 minus 3.9. Full stop. From shareholders of XYZ Limited point of view, we can see that shares offer is better than cash offer. Full stop. Is better than cash offer. Full stop. So from acquiring company point of view, offering cash consideration is better than shares consideration. Full stop. Reading second last paragraph once again. Evaluate whether the proposed share for share offer likely to be beneficial to the shareholders of both A Limited and T Limited, that is PQR Limited and XYZ Limited. Please use the information and merger terms available above. You may make appropriate assumptions to forecast post-merger values. Now all these things that we have done, we have evaluated. from acquiring company point of view, target company point of view, that if at all there are no synergy gain, then in that case what is the situation? If price earning ratio of the merged firm is same as A Limited before merger, what is the situation? All those things have been completed. Now let us have understanding importantly like this. Over here you can see that in the third paragraph, information is provided for the target company like this. XYZ Limited is another company in the same line of business but has been established much longer. It sources more to traditional business sectors and earning track record has been erratic. In most of the daily newspaper, poor management have been blamed for poor performance of the company, and due to this, stock of the company in the market had lost its value for some times. The current earning forecast of XYZ Limited is also 4% for the foreseeable future. The capital structure of the company consisting of 18 crore equity share capital of rupee 1 par value. Profit before taxation of the company for the year ending 31st of March 3001 is 11.25 crore. Considering this information about target company, that the recent performance had been poor, newspaper have criticized the management of the company because that is for all these things. Like that, all this information is provided to us. So, institute has given further suggested answer. Further suggested answer is calculation of the price of the security. Calculation of the price of the security based on earning capitalization method. Based on earning capitalization method. What does the term earning capitalization method mean? Earning capitalization method means calculation of price of the security based on present value of the earning. Calculation of the price of the security based on present value of the earning. Based on that, we are required to make the calculation of the price, and further comment we are required to pass on. For calculation of the price of the security based on earning capitalization method, we are required to do working something like this. PQR Limited, XYZ Limited. Let me explain you, please do not write anything. We already have earning after taxes figure. We already have number of shares figure. With that we can make the calculation of EPS. This will become EPS of year 0, that is current EPS, current year EPS. EPS at the end of year 1 will be calculated as EPS of year 0 into 1 plus G. You can see that the growth rate is provided to us, that it is 4%. In the second paragraph you can see information is given to us. As per Chairman cum Managing Director's statement included in the forecast column of company's annual report for the year ending 31st of March 3001, earning might be expected to rise by 4%. So 4% is provided as the growth rate for PQR. In the third paragraph, it has been provided to us in the fifth line. Current earning forecast of XYZ Limited is also 4% for the foreseeable future. So, taking into account EPS of year 0 into 1 plus G will make calculation of EPS of year 1. Based on that, P0 will be found. It is E1 divided by K minus G. E1 is calculated by us, that is EPS into 1.04. EPS into 1.04 divided by cost of equity minus growth rate. Cost of equity is provided to you after the table. The corporate tax rate is 30%. PQR is post-tax cost of equity 13%. So for this it is 13%. and XYZ Limited it is 11%. So over here it is 11%. Based on that, so the price of the security will be calculated. This price of the security, will be compared with current market price of the security which we already have, that is 3 rupee 90 paise and 3 rupee 6 paise. Based on that we will pass further comment. And further we will evaluate the situation. Let us see the calculation of P0 based on earning capitalization method. Name of the company PQRXYZ. Earning after taxation 8.862 crore, 7.875 crore. Number of shares. Rupees 50 crore is the equity share capital divided by 2 rupees per share. Rupees 18 crore is the equity share capital divided by 1 rupee per share. So this is the number of shares. Earning after taxation divided by number of shares. With that, we'll make the calculation of EPS of year 0. 0.35448, 0.4375. EPS at the end of year 1 is EPS of year 0 into 1 plus G. Like that, 0.35448 into 1.04, 0.4375 into 1.04, 0.3687, 0.4550. EPS at the end of year 1 divided by KE minus G. So 0.3687 divided by KE minus G, 0.4550 divided by KE minus G. So it is 4 rupee 10 paise and 6 rupees 50 paise. Please write down answer from board. Let us see comparison of price based on earning capitalization method with current market price of the share. For PQR Limited and XYZ Limited, P0 based on earning capitalization method 4 rupee 10 paise, 6 rupees 50 paise, less current market price of the security 3 rupee 90 paise and 3 rupee 6 paise. So we can say that there is undervaluation. We can see that there is undervaluation. Over here, there is undervaluation of only 20 paise. Over here, there is undervaluation of only 20 paise. Over here, undervaluation is 3 rupee 44 paise. That is undervaluation of 3 rupee 44 paise. That is what we can see. So both market price are undervalued. However, market price of the target company is substantially undervalued. Market price of the target company is substantially undervalued. Why? The reason is provided to us in the example that past records of the earning had been erratic. Newspaper is blaming management of the company for this poor performance. So price of the security, this security is out of favor from the stock market, and because of that, price of the security is substantially undervalued. So what we can conclude? We can conclude from acquiring company point of view, there is an excellent opportunity to acquire target company. Acquiring company point of view, there is an excellent opportunity to acquire target company by offering a premium which is on current market price of the security. Offering slight premium on the current market price of the security, shareholders of target company will be ready to accept the offer. And actually, acquiring company is able to get a company which is having substantially higher value. Like that we understand. Please write down this answer from board. Please write down a note. I am dictating a note to you. You are requested to write down answer along with me. We can see that current P0 is lower than P0 based on discounted value of earning. Discounted value of earning. Full stop. With paragraph write down, price of both securities are undervalued, comma, however, price of XYZ Limited is substantially undervalued. Full stop. Further write down, the reason for that is its earning track record has been erratic. Its earning track record has been erratic. Full stop. Further write down in that, in most of the daily newspaper, comma, poor management have been blamed. Poor management have been blamed for poor performance of the company. Full stop. With paragraph write down, from PQR company point of view, there is a good opportunity to take over XYZ, comma, by offering premium over current market price of the security, and actually taking over a company which has substantial higher present value full stop. Friends, question number 10A and question number 10B are exactly same. 10A, 10B are exactly same. Both the questions are of institute publication. Suggested answer for both the questions are exactly the same as what I have dictated to you. The important point to which I want to draw your attention is that as far as the question number 10B is concerned, from the question it is difficult to understand that this is the kind of suggested answer that they are expecting. In question number 10B, there is a problem that from the question itself it is difficult to estimate that this is the answer that they are expecting. However, now we understand, if at all we have been provided with the problem of the target company that recent performance had not been good, market price of the security was low, track record of the earning has been erratic, or such kind of information, then in that case we are required to do the answer in 3 steps. Step number 1, calculation of the answer as if there is no synergy gain. Second, calculation of the answer if price earning ratio of acquiring company is same as of merged firm. Third, calculation of P0 based on earning capitalization method. Let us read question number 10A once again. AB Limited has recently approached shareholders of CD Limited, which is engaged in the same line of business as that of AB Limited, with a bid of 4 new shares in AB Limited for every 5 shares of CD Limited, or cash alternative of 360 rupees per share. So in 10A, the question provides information that 4 shares against 5 or 360 rupees. In case of, and that is in question number 10B, 5 shares for every 6 or cash of 3 rupees 45 paise per share. Reading question number 10A, pre-bid information for the year ended 31st of March 2001 are as follows: equity share capital, number of shares, pre-tax profit, price earning ratio, estimated post-tax cost of equity per annum. Both AB Limited and CD Limited pay tax at the rate of 30%. Current earning growth forecast is 4% for the foreseeable future. You are required to answer that. Assuming no synergy exists, you are required to evaluate whether proposed share-to-share offer is likely to be beneficial to shareholders of CD Limited using merger terms available? Question mark. AB Limited's directors might expect their own pre-bid price earning ratio to be applied to combined earning. Whether merger terms are favorable for CD Limited? Question mark. Also comment on the value of the two companies from the constant growth form of dividend valuation model, assuming all earnings are paid out as dividend. So what we can see? We can see that, say, there are 3 things that we are required to do. Assuming no synergy, assuming price earning ratio of acquiring company itself is of the merged firm, and third, calculation of the price based on earning capitalization method. And then the price calculated based on earning capitalization method will be compared with the current P0, and based on that we are required to see overvaluation or undervaluation of security. That is the way we are required to make calculation of answer. Please write down a note. I am dictating a note to you. You are requested to write down answer along with me. First point, whenever we have been provided with information about poor performance of target company then in that case we are required to calculate answer in following order. Full stop. In that write down A. Calculate answer as if there is no synergic gain. B. Calculate answer if PE ratio of merged firm is same as A Limited post merger. C. Calculate P0 based on earning capitalization method. Full stop. Second point, current P0 will be compared with P0 based on earning capitalization method, comma, afterwards we are required to quantify over slash undervaluation of security, full stop. Question number 11A. From following information, you are required to ascertain whether merger is beneficial or not. Highlight the portion for acquiring company. Following information is given about FCF, free cash flow. The cash flows are provided in 1000 rupees. End of year 1 and end of year 2, NOPAT, net operating profit after tax, 65,000, 70,200. Capital expenditure 30,000, 32,000. Depreciation 20,000, 22,000. Change in working capital 20,000, 22,000. NCF, or we can say FCF, free cash flow, net cash flow, 35,000 rupees for year 1 and 38,200 for year 2. You can use your calculator to verify that whether this answer is correct or not. 65,000 minus 30,000 of capital expenditure. So 65 minus 30, that comes to 35. Plus depreciation 20,000, because depreciation is a non-cash item which must have been subtracted in calculation of NOPAT. So adding 20,000, so it comes to 55,000. 55,000 minus 20,000, because change in working capital is understood to be increase in working capital 20,000. So 55 minus 20, that comes to 35,000 for the first year. Similarly for second year, 70,200 minus 32,000 plus 22,000 minus 22,000. Like that, it comes to 38,200. Cash flows are expected to grow at 7% forever thereafter. So the growth rate is 7% for perpetuity, for infinity, forever. Assume that there are 4 comparable firms. Their beta and debt equity ratios are given below. So we understand that we have been provided with the information as year 1 and year 2. The amount of free cash flow, it is 35,000 rupees and it is 38,200 rupees. Cash flow is likely to grow at the rate of 7% for perpetuity. There are 4 comparable firms. Firm number 1, 2, 3, 4. For each of the firm, beta is given and debt equity ratio is given. Everybody is requested to concentrate over here. Proportion of debt financing in respective equity financing. 0, firm number 2. 0.4, firm number 3. 0.44, firm number 4. And 0.50, that is firm number 1. Beta, it is 0.6, 0.8, 0.9 and 1. We know that the beta is measurement of risk. With the increase in beta, risk increases, that is beta increases. Assume following parameters. Risk-free rate of return 12.2%. Market premium, that is market risk premium, RM minus RF, is 10%. The acquisition price of rupees 3,30,000 will be financed with 99,000 rupees of debt finance. So we have been provided with the total cost of rupees 3,30,000, which has 2 bifurcation. 99,000 rupees is debt finance and 2,31,000 is equity finance. Like that information is given. it will be brought down. So the amount of debt finance rupees 99,000, it will be brought down. End of year 1, 92,400. End of year 2, 85,800. The indebtedness is expected to remain at that level, that is 85,800 forever. Tax rate is 35%. And the rate of interest is 14%. Reading the first paragraph, from the following information, it means that all this information, you are required to ascertain whether merger is beneficial or not for acquiring company. So we are required to take decision from A limited point of view. From A limited point of view, whether acquisition should be made or not, that is the question. Everybody is requested to go through the question carefully. Everybody is requested to go through the question carefully so that we can now calculate answer of the question. So please go through the question carefully, every one of you. Let us see that how to take decision from acquiring company point of view, that whether target company should be acquired or not. Let us see that from acquiring company point of view, whether target company should be acquired or not. Everybody is requested to stop writing. Let me explain you that how we are required to calculate the answer. The answer is required to be calculated something like this. Friends, over here what we can see? We can see that capital structure of the company. We can see that capital structure of the company keeps on changing. Year 0, the amount of debt financing is rupees 99,000. End of year 1, it is 92,400. End of year 2, it is 85,800. Since capital structure of the company is changing, so as per institute suggested answer, we are required to make the calculation of APV instead of NPV. We are required to make the calculation of adjusted present value instead of net present value. That is the way we are required to make calculation of answer. Everybody is requested to consider it over here. APV technique is a technique that we have studied in our chapter of capital budgeting. APV technique is a technique that we have studied in our chapter of capital budgeting. I hope you recall that in APV technique, we are having like the decision making technique similar to calculation of NOI approach similar to NOI approach of capital structure theory. As far as the NOI approach of the capital structure theory is concerned, that is net operating income approach. In that we know, so there are two conclusions. First is a conclusion, if at all there is a situation of no taxes. Second is a conclusion, if at all there is a situation of taxes. If at all there is a situation of no tax, if at all there is a situation of no tax, then in that case we understand something like this, that nothing is optimal capital structure. All capital structures are equally optimal. We understand that irrespective of the proportion of debt finance introduced in the capital structure, overall cost of capital will always remain same. Weighted average cost of capital will always remain same, like that we understand. That is what we have, a kind of situation if at all say there are no taxes. We understand that if at all there is a situation of no taxes, with the increase in debt finance, cost of equity increases, and it increases in such a way, so that advantage of raising debt source of finance, advantage of raising lower cost of funds is compensated, and because of that overall cost of capital is same as it was earlier. Weighted average cost of capital is same as it was earlier, like that we understand say in this situation. If at all there are no taxes. In case of net operating income approach, the importance is given to operating income, that is earning before interest and taxes. Why? Because doing business is important. A company can generate its value based on the earning that it has and not because of its capital structure. That is what we have a situation if at all there are no taxes. If at all tax information is there, then NOI approach says that with the introduction of debt finance, the company is able to get advantage of introducing a source of finance which is having lower cost. Second, marginal cost of equity, marginal cost of capital increases. These two things are say compensated against one another. However, due to introduction of debt finance, the company is able to get advantage of interest tax shelter. The company is able to get advantage of interest tax shelter. So basically, present value interest tax shelter is increasing the value of levered firm. So value of levered firm is more than value of unlevered firm. In a way that so the value of levered firm is value of unlevered firm plus present value interest tax shelter, which is calculated as B into T. I hope you remember so the derivation of the formula that we have done for present value interest tax shelter in our chapter of cost of capital and capital structure theory that we have done. So we understand that say as per NOI approach with taxes an optimal capital structure exists. A capital structure which is having maximum debt finance is an optimal capital structure, because in that case the value of the firm is highest and overall cost of capital is lowest. That is what we understand over here. Everybody is requested to stop writing. Let me explain you further. Whenever we are required to calculate value of levered firm, then first of all we calculate value of unlevered firm. and afterwards we make the calculation of present value interest tax shelter. Whenever we are required to calculate the value of levered firm, first of all we calculate the value of unlevered firm. Then present value interest tax shelter is added to the same to calculate the value of levered firm. That is what we understand. This is what we understand is the amount of debt financing into tax rate. Now whatever this approach that we have for calculation of the value of levered firm, in case of NY approach with taxes, similar approach that we have as far as calculation of APV is concerned, that is calculation of adjusted present value is concerned. In that case we are required to do working something like this. Everybody is requested to concentrate over here. In case of adjusted present value approach, first of all we make the calculation of base NPV. How base NPV is calculated? Base NPV is calculated as PVCI minus PVCO. How PVCI is calculated? PVCI is calculated as cash inflow discounted at cost of equity of unlevered firm. Cash inflow discounted at cost of equity of unlevered firm. And present value cash outflow means, say, total project cost. That is what we understand is present value cash outflow. Everybody is requested to stop writing, let me explain you. Basically what happens that in calculation of APV, first of all we make the calculation of base NPV, wherein an assumption is made that the entire project is financed with equity source of finance. So the cash inflow to be received is discounted with cost of equity of unlevered firm. Over here important thing is that cost of equity of unlevered firm is the rate at which the cash flows are required to be discounted for the purpose of calculation of PVCI, and from that the project cost is subtracted to make the calculation of base NPV. Once we calculate the base NPV, afterwards we are required to make the calculation of present value interest tax shelter. Friends, importantly, what do we understand? We understand that with the introduction of debt financing, there are three things that take place. First, marginal cost of equity source of finance increases. Second, the company is able to get advantage of lower cost of capital source of finance introduced in the business. However, effect of these two are nullified against one another. The only thing which is remaining is advantage of interest tax shelter. So present value interest tax shelter advantage is added to base NPV. For the purpose of calculation of APV, adjusted present value. Like that we understand. I just repeat the reason for applying APV technique in this question. Once again I repeat the reason for applying APV technique in this question. As per institute suggested answer, proportion of debt financing is not constant. Proportion of debt financing keeps on changing. Because of change in the proportion of debt financing. Because of change in the proportion of debt financing, we understand that say we cannot adopt NPV approach for the purpose of decision making. Instead of NPV approach, we are required to apply APV approach. APV stands for adjusted present value. In case of APV approach, we are required to calculate the answer into two parts. First, we will make the calculation of APV, and then second, we'll compute the present value interest tax shelter discounted at the rate of interest to make the calculation of APV. That is the way we are required to calculate the answer. Please write down a note. I am dictating a note to you, friends. First point, in this question, we can see that capital structure of the company, is not same comma throughout life of the project, full stop. So instead of NPV approach, comma APV, in bracket write down adjusted present value, bracket over, approach is adopted. Full stop. Second point, in calculation of APV, comma, we have to follow similar working, comma NOI approach, full stop. In case of NOI approach, comma, we know that, comma, in a situation of taxes, comma, to calculate value of levered firm, first of all we have to find value of unlevered firm, full stop. Third point, In case of NOI with taxes, comma, to calculate value of levered firm, to calculate value of levered firm, comma, present value interest tax shelter, present value interest tax shelter is added to value of unlevered firm, value of unlevered firm, comma, to find value of levered firm. Full stop. Present value interest tax shelter, present value interest tax shelter is calculated comma, by discounting interest tax shelter with rate of interest, full stop. Fourth point, write down, in order to calculate APV, comma, first of all we will calculate base NPV, full stop. Base NPV means, comma, calculation of NPV, comma, assuming that entire project is financed by equity source only, full stop. Fifth point, write down, after calculating base NPV, comma, we will find present value interest tax shelter, comma, which will be added to base NPV, comma, to calculate APV, full stop. Fifth point, present value interest tax shelter. Present value interest tax shelter will be calculated by discounting interest tax shelter with rate of interest, full stop. Friends, over here we have been provided with the information about proxy firm. Four comparable firms, that information is given. What does that mean? Friends, we can understand something like this. Suppose a company is presently doing business of manufacturing a product. Let us say that it is like the automobile parts. It is presently doing that business. Now it is diversifying in a new line of business. Let us say that in information technology sector, in IT sector. Then the risk of like manufacturing automobile parts and the risk of IT sector, we can say that both businesses are different. So risk aspect for both businesses are different. Both line of business are different. So risk for both line of business are different. So a company which is diversifying in a new line of business cannot apply existing cost of capital as discounting factor for like the cash flows of the new business. Whatever the new business that the company is going to do, for that anticipation of the cash flow is made. Now those cash flows cannot be discounted with current cost of capital. For that, the risk adjusted cost of capital for that industry is required to be found. So with that, there is a concept called beta of asset, which we are going to learn in detail in our very simple chapter, portfolio management. Right now we have been provided with such kind of information about proxy firms. Proxy firm means companies doing similar business in that line of business. For example, say a company is going to manufacture like mobile phone. Then for that company, which is proxy firm, Nokia is proxy firm. Samsung is a proxy firm. If at all a company is going to enter into the business of manufacturing motor car, then which is proxy firm? Ford is proxy firm. Maruti is a proxy firm. Like that, these are the proxy firms. Now this is the way information is provided to us. We understand that the kind of information which is given with the increase in the proportion of debt financing, with the introduction of leverage, expectation of equity shareholder increases. In a way that the beta of equity share increases, that is what we can see. So we understand over here something like this. That with the increase in debt financing, risk increases. However, the point at which there is no debt financing, that is what we understand as unlevered firm. So the form number 2 information which is given to us. That is what we understand is information provided to us about unlevered firm. debt equity ratio is 0. So the beta of equity share is also so in that case the beta of equity share is 0.6. So we understand that beta of equity share, that is risk that investors believe that the equity share investment has, is 0.6 when there is no leverage, when there is no debt financing. So as far as the calculation of the cost of equity is concerned, for unlevered firm, we will apply this formula. Formula is Rj is equal to Rf plus beta into Rm minus Rf. What is risk-free rate of return? Risk-free rate of return is 12.2%. What is beta? Beta of unlevered firm is 0.6. What is Rm minus Rf? Rm minus Rf is 10%. So 12.2% plus 6%. So it is 18.2%. So we understand that in order to make the calculation of base NPV, expected cash flows will be discounted with cost of equity of unlevered firm, and that is 18.2%. Expected cash flows will be discounted with cost of equity of unlevered firm, that is 18.2%. By applying that as discounting rate, we will make the calculation of NPV, and so that is considered to be base NPV. That will be our first step for calculation of APV. Please write down a note. I am dictating a note to you, friends. In calculation of KE of unlevered firm, we will take base of CAPM, in bracket write down capital asset pricing model. Capital asset pricing model, bracket over and full stop. With paragraph write down, as firm number 2 has 0 debt equity ratio, it means it is unlevered, full stop. Taking beta of firm number 2, we will calculate RJ, that is cost of equity, full stop. Proxy firm means a firm dealing in that line of business, full stop. In bracket write down, to be discussed in detail, in our chapter of portfolio management. portfolio management, full stop. Concept is beta of asset, full stop and bracket over. Working note number 1, calculation of RJ, that is K. This calculation is made for an unlevered firm. RF plus beta into RM minus RF. RF 12.2, beta 0.6, which is taken from firm number 2, into RM minus RF 10%. So 10% into 0.6, that is 6%, plus 12.2, that is 18.2. This is what we understand is the cost of equity of unlevered firm. That is what we understand. Unlevered is very important. This cost of equity will be used as discounting factor. This cost of equity will be used as discounting factor to calculate NPV, that is called base NPV. Please take an answer from board. Let us see working note number 2, calculation of base NPV. Year 0, end of year 1, end of year 2, and based on that base NPV will be found. Cash inflow 35,000 rupees first year end, 38,200 second year end. This cash flow will grow at the rate of 7% for perpetuity, for infinity, forever. Discounted value of the same for second year end is 3,64,946. Investment 3,30,000. Taking these three cash flows into account, we will prepare a net cash flow series. 3,30,000 cash outflow, 35,000 inflow, 4,03,146 inflow. This will be discounted at 18.2%, that is cost of equity of unlevered firm, as if the entire project is financed through equity finance. Since we are having the calculation assuming that the entire project is financed with equity finance, that 99,000 rupees of debt financing that we have raised, it is ignored right now. 99,000 rupees of debt financing that we have raised, it is ignored right now. Applying this as discounting factor will make the calculation of NPV, and that is called base NPV. As far as the P2 value is concerned, P2 value is calculated as A3 divided by KE minus G. Third year cash flow is 38,200 into 1.07 divided by KE minus G. In a way that this is the third year cash flow, which will grow at the rate of 7% for perpetuity. Discounted value of the same 364,946. It is second year end value. Please take down answer from board. Working note number 3. Calculation of present value interest tax shelter. Year 1, year 2. The amount of interest tax shelter is 99,000 rupees debt financing into 14% interest into 35% tax rate. So first year interest tax shelter is 4851. Some amount of debt financing is repaid at the end of year 1. So end of year 1 outstanding debt is 92,400. Once again 14% is the rate of interest and 35% is the tax rate. So second year interest tax shelter is 4528. Second year end further some amount of debt is repaid. So third year onwards for perpetuity amount of debt financing is same. Third year onwards for perpetuity amount of debt financing is same. So whatever interest tax shelter from end of year 3 onwards for perpetuity that company is going to receive is discounted to end of year 2. P2 is equal to A3 divided by I. A3 is interest tax saving for the third year, which is going to remain constant for perpetuity, divided by rate of interest, that is 14%. What is interest tax saving? It is 85,800 into 14%. This is the amount of interest into tax rate, interest tax shelter. So numerator is interest tax shelter divided by rate of interest 14%. So the amount of interest tax shelter is 30,030, which is of second year end. That is the interest tax shelter over here. Taking into account the first year interest tax shelter, second year interest tax shelter and P2 value, net cash flow is found, which is discounted at 14% and present value of interest tax saving is calculated. It comes to 30,847. Please take the answer from board. Working note number 4, calculation of APV, base NPV plus present value of interest tax savings, tax shelter. Negative 11,818 plus 30,847. So it comes to 19,029. Please take an answer from board. Please write down answer along with me. As APV is positive, comma, the company is advised to take over target company, full stop. Friends, I hope everybody is clear with the point that assuming that there is no debt finance, we make the calculation of base NPV. However, actually debt finance is introduced. So whatever the amount of NPV that we have calculated, it is incorrect NPV, because introduction of debt finance will have three effects. First, cost of equity increases because expectation of equity shareholder increases. Whatever the discounting rate at which we have calculated NPV, that will not be the discounting rate, that will not be the cost of equity if debt financing is raised. Second, the company will get advantage of raising a source of finance which is having lower cost. And third, importantly, the company will get advantage of interest tax savings. Actually, these two factors are compensating one another. So the only thing which we have not considered in this calculation is interest tax saving. So present value of interest tax saving is added to the base NPV to calculate APV, adjusted present value. Students are requested to have understanding that neither we have considered raising of debt finance anywhere in the question, nor we have considered repayment of debt finance anywhere in the question. Taking loan, repayment of loan, all those cash flows have been ignored by us. Why? Because over here, so the approach of making calculation is similar to NY approach. wherein to calculate the value of levered firm, first of all we calculate value of unlevered firm. Then interest shelter advantage is added to calculate the value of levered firm. Raising of the debt finance has three effects. 1, 2, 3. First is, so the company is having advantage of raising a source of finance having lower cost. Second, marginal cost of equity increases. Basically, these two are having no effect because one equals to other one. The only factor which we are supposed to consider now is interest tax saving, which we are considering for calculation of APV. As these two factors are same, so in a situation of no taxes, there is no optimal capital structure. The important point which I want to convey is that in calculation of the cash flow, neither of this is required to be considered by us. The only effect of this is required to be incorporated over here. Effect of this is required to be incorporated over here for the purpose of calculation of answer. Let us see question number 11b. Let us see question number 11b. ABC, a large business house, is planning to sell its wholly owned subsidiary KLM. I read that once again. ABC, a large business house, is planning to sell its wholly owned subsidiary KLM. Another large business entity, XYZ, has expressed its interest in making a bid for KLM. So XYZ is acquiring company and wholly owned subsidiary of ABC, that is KLM, is target company. XYZ expects that after acquisition, annual earning of KLM will increase by 10%. So, earning is likely to increase by 10%. Following information, ignoring any potential synergic benefit arising out of possible acquisitions, are available. Profit after taxation for KLM for the financial year which has just ended is estimated to be 10 crore. So profit after taxation of KLM 10 crore. KLM's after tax profit has an increasing trend of 7% each year and the same is expected to continue. Growth rate is 7% for perpetuity. Estimated post-tax market return is 10% and risk-free rate of return is 4%. So return on market portfolio 10% and risk-free rate of return is 4%. These rates are expected to continue. Tax rate 30%. Then you have been provided with a table XYZ, that is acquiring company, ABC, that is like holding company of target company, and a proxy entity for a KLM in the same line of business. Highlight the portion proxy entity. Number of shares 100 lakhs, 80 lakhs. P0 287, 375. 1 minus B, that is dividend payout ratio 40%, 50%, 50%. Debt equity at market value 1:2, 1:3, 1:4. Price earning ratio 10 times, 13 times, 12 times. Equity beta 1, 1.1 and again 1.1. Assuming gearing level of KLM is to be same as for ABC Limited. Highlight the portion gearing level of KLM to be the same as for ABC, and debt beta of 0. It is not required to be given that debt beta will be 0, it is assumed otherwise also. You are required to calculate A. Appropriate cost of equity for KLM based on the data available for proxy entity. B. A range of values for KLM both before and after any potential synergic benefit to XYZ for acquisition. Students are requested to go through the simple question, please.